Let's discuss the capital asset pricing model and Jensen's alpha. So the capital asset pricing model is just a way to determine the expected return of an investment, but it only really works for a well-diversified portfolio. So because it only accounts for beta, which is a measure of systematic risk. So the formula is going to be as follows. So expected return is going to be the risk-free rate, which is defined usually as a 13-week T-bill. It's the quarterly T-bill because there's, 4 quarters in a year. 13 times 4 is 52, 52 weeks in a year. So it's the quarterly return of the T-bill plus the beta times the risk premium. Risk premium is going to be defined as market return minus the risk-free rate. Market return minus the risk-free rate. That's called the risk premium. Market would be the return of like the S&P, and risk-free rate, again, 13-week T-bill. Beta is just a measure of systematic or market risk, essentially, and it basically measures how much a stock fluctuates with the market. So, for example, if stock ABC has a beta of 1.2, that means that if the S&P were to go up 10, the stock would go up 12. If the stock goes down 10, the portfolio goes down 12. Now, Jensen's alpha. Jensen's alpha just adds another component into the expected return equation. And basically what alpha is, it's a measure of non-systematic or like stock-specific risk or portfolio-specific risk, right? Non-systematic risk or unsystematic. And the way you would really calculate, so the best way to illustrate it would be in simple terms, if we don't include the risk-free rate, would be like if you had let's say a stock with a beta of 1.2 and the market goes up 10, and instead of the stock going up 12, it goes up 15. In that case, the alpha would be 3. That's if we don't include the risk-free rate in the calculation. It gets a little more complicated if we include the risk-free rate. But just to kind of illustrate what I'm talking about. So now, Jensen's alpha would really just be if you could calculate the expected return and you're given the actual return of the portfolio. So if the portfolio exceeds the expected return, you have a positive alpha. That's a good thing, right? And vice versa, if the expected return, what you should be getting is more than what you're actually getting, that's a problem. You have a negative alpha. That's bad. We're in this business, we're always just seeking alpha, apropos to, the famous, stock picking website. So if we were to really expand out Jensen's alpha, combine the actual minus expected return, put it back into CAPM, so now we're going to end up having basically our alpha is going to be our actual return minus expected, and you expand out expected to make it risk-free rate plus beta times the risk premium, and the risk premium, again, is going to be the market return minus the risk-free rate. Hope that makes sense. Please listen and subscribe and like, and hope you have a great day. Thanks.